Your bank balance is not a stack of bills sitting in a vault. It is a promise conjured into existence the moment someone went into debt. The biggest lie in finance is not hidden in fine print. It's the comforting story that banks simply hold your cash for safekeeping. Once you see how money is really made, the world you live in will look different. You're watching Hidden Finance, the place where we pull back the curtain on money, power, and the systems that shape our lives. In this episode, we follow the paper trail behind the screen, from ancient ledgers to modern smartphones, to understand why your money isn't where you think it is. We'll travel through panics and policy, from goldsmiths to central banks, to unravel a simple but unsettling truth. Banks don't just store money in a very real sense, they write it into being. And that's not a conspiracy, it's how the system was built. To understand this, start with a question: what is money? It's not just coins or paper. It's an agreement, a network of I owe us we all accept as payment. In reality, the vast majority of money in modern economies is not physical cash, but bank deposits. Numbers on a screen that spend like cash because we trust the system behind them. Those numbers are promises, and promises must be kept unless trust breaks, and then the numbers can vanish. The entire structure relies on confidence, speed, and the quiet machinery of banking. Centuries ago, English goldsmiths discovered a secret. People brought gold for safekeeping and accepted paper receipts in return. Over time, those receipts started circulating as money because it was easier to pass a note than lug metal around. Goldsmiths noticed most depositors didn't redeem their gold at the same time, so they began issuing more receipts than gold held, creating purchasing power from thin air. That insight wasn't just profitable. It was the birth of fractional reserve banking and the beginning of modern money creation. By 1694, the British Crown formally harnessed this power by founding the Bank of England, a bank that could issue notes backed by the state. With the 1844 Bank Charter Act, the right to print banknotes was tightly controlled, but deposit banking numbers in accounts created by private banks expanded rapidly. The crucial shift had occurred. Paper claims to money, and later electronic deposits, became the main form of money people used. The notes in your wallet might come from the central bank, but the balance in your account largely comes from private banks. The stage was set for a world defined by credit. Across the Atlantic, 19th century America was a laboratory of banks, panics, and experiments. Currency was issued by private banks against government bonds, and every region had its own quirks and risks. Panics arrived like storms, sudden and devastating, culminating in the Panic of 1907 when trust evaporated and the system froze. J.P. Morgan himself corralled bankers to restore order, but it was a stopgap. The chaos gave birth to a permanent solution: the Federal Reserve in 1913, a lender of last resort to back the system in a crisis. The Great Depression tested that promise. As banks failed, depositors lined up in the cold, trying to pull cash from an empty idea. In 1933, the U.S. created Federal Deposit Insurance, an invisible but powerful guarantee that transformed the psychology of money. Suddenly, deposits felt safe even if the bank didn't have the cash on hand. With rules like Glass-Steagall separating commercial and investment banking, trust began to return, but a deeper truth endured. The modern money supply is largely created by bank lending. After World War II, the Bretton Woods system anchored global currencies to the US dollar and the dollar to gold, but only for foreign governments. For everyday people and businesses, money was still mostly deposits and credit. Offshore, in the 1950s and 60s, dollar deposits began to multiply in foreign banks, the euro-dollar market beyond the direct reach of the Federal Reserve. Then, in 1971, President Nixon closed the gold window, ending dollar convertibility to gold. Money became entirely a matter of trust and policy, not metal. A profound turning point that few understood at the time. So how do banks actually create money? Imagine a baker named Sarah wants a loan to buy an oven. She sits with a loan officer, signs the papers, and in a few clicks, her account shows $50,000. No one moved cash from a vault. The bank created a new deposit, a new promise, by recording a loan on its books as an asset and a matching deposit as its liability. Two sides of a ledger credit and debit summon spending power into existence. When Sears spends the money, the bank's promise is tested, but at the moment of creation, money is born as a line in an account. What about reserves, the funds banks hold at the central bank? Those are used to settle payments between banks and to meet regulatory requirements, but they don't limit lending the way most textbooks once taught. The old story of a simple money multiplier, where banks lend out a fraction of deposits, is misleading in modern systems. In practice, banks lend first if they judge it profitable and safe, then find reserves later through the central bank or the interbank market. Even central banks have confirmed this view. Loans create deposits, and the plumbing adjusts after the fact. So what does limit a bank? Not a jar of cash, but risk, regulation, and capital. Banks must hold capital real shareholder money against their assets, and the riskier the loans, the more capital they need. Global rules known as the Basel Standards push banks to fund themselves with enough loss-absorbing buffers to survive shocks. Liquidity rules force them to hold assets they can quickly sell. In the end, what constrains lending is not a reserve bucket, but the hard reality of profits, capital, regulation, and trust. As financial markets evolved, banks found ways to create and distribute credit faster than traditional limits implied. Mortgages were bundled into securities and sold to investors, turning future payments into cash today. Ratings turned complex risks into simple labels, and balance sheets spun faster under the promise that housing always went up. The model shifted: originate the loan, then distribute the risk-freeing space to originate even more. It was a powerful machine for creating money like claims outside the classic banking system. In 2008, the machine seized. A slow turn in housing prices cracked the structure and became a run not on bank branches, but on funding markets, securities lenders, and short-term repo. Trust evaporated, collateral was questioned, and global finance found itself gasping for air. Central banks responded with emergency lending and vast asset purchases known as quantitative easing. They weren't printing bags of cash for consumers. They were injecting reserves and buying securities to unfreeze the system. The aftermath remade the balance of power. New rules: Basel III forced banks to hold more capital and more liquid assets, and to plan for stress. Traditional banks became safer, thicker with capital and buffers, but risk migrated into the shadows. Private credit funds, non-bank lenders, and offshore dollar markets. Asset prices climbed for years as ultra-low rates fueled search for yield. Growth was modest, debt was plentiful, and the line between money and money-like blurred even further. Then came 2020, a pandemic froze the real economy, and governments fired fiscal cannons to keep households and businesses afloat. Central banks bought mountains of bonds, and deposits surged as government spending landed directly in bank accounts. In the US, reserve requirements were set to zero because they weren't the true constraint anyway, and banks parked excess reserves at the central bank for interest. A flood of new deposits was created not by bank loans, but by public spending financed through the financial system's plumbing. When the world reopened, demand collided with fragile supply chains, and inflation woke up. To fight it, central banks raised interest rates at the fastest pace in decades. Some banks, like Silicon Valley Bank in 2023, were caught holding long-term bonds that fell in value as rates jumped, while their concentrated deposit base sprinted for the exits on smartphones. It was a modern bank run, swift and digital. Once again, authorities stepped in to protect depositors and stabilize trust, because the promise must be believed to survive. Looking back, the turning points are stark. In 1971, money slipped the anchor of gold and became purely a matter of promises and policy. In 2008, we learned that crises don't always look like lines outside a branch. They can be global, instant, and hidden in plumbing. In the 2010s, central banks taught in plain language that banks create money when they lend, and that reserves follow. And in the 2020s, the speed of information turned bank runs from days to hours, making trust more fragile and more essential than ever. The consequences of bank-created money ripple through everyday life. Credit boons can lift economies, fund innovation, and put roofs over families until they overheat. When too much money creation chases scarce assets, housing becomes a battleground and inequality deepens as asset owners gain first. Those closest to the flow of new credit banks, large borrowers, financial markets often feel the benefits before everyone else. Meanwhile, those farthest from the tap face rising prices and rising hurdles. Globally, credit creation doesn't respect borders. The dollar's reach means that banks and investors outside the US create dollar deposits offshore, shaping the fate of countries far away. When global dollar funding tightens, emerging markets can face sudden stops, capital flees, currencies fall, and growth sputters. The Asian financial crisis in the late 1990s and waves of stress since then have carried the same signature. Too much short-term foreign credit, withdrawn too fast. The euro area, too, learned that a shared currency requires shared backstops, or trust can fracture within a single market. So where do we go from here? Technology is building new rails, fintech apps, instant payments, and digital wallets that move money with a swipe. Stablecoins promise digital cash, backed by high-quality assets, trying to look like deposits without being banks. Central banks are exploring digital currencies that could be as safe as cash, but as convenient as an app, raising hard questions about what happens to bank deposits if the public can hold central bank money directly. In this contest, the core question remains, who should have the power to create money, and on what terms? Some argue for narrow banking, where deposits are backed one-for-one with safe assets, and lending is done by funds that bear visible risk. Others defend the current model, saying that bank-created money is the engine of growth and that the true fix is better supervision, more capital, and smarter rules. There's also a quieter revolution in plain sight. Governments create bank deposits every time they spend by crediting accounts in the private sector, reminding us that public policy can expand or contract money too. In the end, money is a social choice wrapped in code, law, and habit. Change the rules and you change the money. For you, the viewer, the lesson is both practical and profound. Your deposit is a claim on a bank, not a pile of cash, and that claim sits on a foundation of capital, insurance, and central bank support. When fear spreads, speed matters, but so does design. Diversified funding, strong capital, and credible backstops make promises durable. For policymakers, the mandate is clear. Reward resilience, punish fragility, and don't mistake quiet markets for safe ones. For all of us, the story of money is a story of trust we must continually earn. You didn't cause the biggest lie in finance, but you live inside it, spend it, and save it every day. And once you know that banks don't have your money so much as they create it, you can start asking better questions. Who benefits when new money is made? Who bears the risks when it goes wrong? What rules make sense in a world where the balance between credit and stability must be calibrated, not assumed? The answers will shape everything from your rent to your retirement. Here is the heartbeat beneath the headlines. Banks are not vaults, they are factories of promises. Those promises can power prosperity when they finance real productivity, and they can breed fragility when they chase speculation and shortcuts. Central banks are the firefighters and sometimes the fuel, while governments set the rules of the game. None of this is ordained, it's designed, and it can be redesigned. We end where we began, with the number in your account. It is not there in the way you imagine. It is a liquid claim in a system that breathes with confidence and contracts with fear. Understanding that is not cynicism, it is clarity. It is the difference between being surprised by every crisis and recognizing the patterns that create them. And in a system built on trust, informed citizens are the ultimate backstop. This is hidden finance, and the money we believe in is only as honest as the stories we tell about it.